Good morning, everyone. My name is Joe Cunningham, and today I will be presenting a financial breakdown of East Coast Yachts with a focus on its statement of cash flows. We'll walk through some key cash flow categories, examine the company's investment, financial activities, and finish with a clear recommendation on whether the recent expansion was a good idea. First, here's a little bit about East Coast Yachts. East Coast Yachts is a company founded by an entrepreneur named Larissa Warren, who started out building custom yachts. The business originally began as a sole proprietorship, meaning she owned and ran her own company. As the company began to grow, it became clear that in order to scale operations, Larissa would need access to more capital. This led to a major decision. Can East Coast Yachts be turned into a major corporation? And why would they? Because as a corporation, the company could issue stocks, attract investors, and raise funds more easily. This expansion was more about just getting bigger. It's about taking East Coast Yachts from a small business into a larger one and becoming a bigger player in the yacht building market. Now here's where our case study begins. The company is coming off a major year. It spent big on capital investments, restructuring its financing and operating. It's completely under a new ownership model. The key question is, was it all worth it? That's what we're here to answer by diving deep into their statement of cash flows, breaking it down into operating, investing, and financing activities, and analyzing the company's overall cash position. We'll look on how they made money, where they spent it, how they funded it, and what it means for their future. Let's start by understanding what cash flow statement actually tells us. It shows us the changes in the company's cash position over a period of time, essentially where the money came from and where it went. The statement is broken into three parts: operating activities, investment activities, and financial activities. The operating activities is a day-to-day business earnings and expenses. The investing activities is a capital spending and asset purchases. Financing activities is how the business is funded through debt or equity. Together, these give us a comprehensive view of the company's cash health. Let's look over operating activities. East Coast Yachts reported a net income of $69 million, which is strong. We add back $18 million in depreciation since it is a non-cash expense. After subtracting taxes and working capital changes, the total cash generated from operations was $72.5 million. That's a pretty solid performance, showing that the company's core business is generating cash efficiently. It is a great sign of an operational strength. Now on to investing activities. This section highlights a long-term investment the company is making. East Coast Yachts spent $535 million on capital assets, which is a major outflow. This is a sign of significant expansion. On the other hand, they bought $5 million from selling some assets, resulting in a net cash outflow of $530 million from investing. This heavy investment suggests that the company is betting on future growth and expanding its production or infrastructure. To fund that expansion, East Coast Yachts turned to financing. Here's how that will break down. $9.9 million in interest paid, $20.3 million used to retire debt, $24.4 million raised by issuing new debt, $29.6 million in paid dividends, $10.4 million on repurchasing stock, but also $30 million raised by issuing new stock. When we net all of that, the company spent $14 million on financing. That shows the balance between rewarding shareholders and raising money to support growth. So let's pull that all together. Operating cash flow, $72.5 million. Investing cash flow takes away, obviously, money you're investing, $530 million. Financing cash flow also takes away some of your capital. It's $14 million. Despite the big outflows in investing and financing, the net effect is a positive cash change of $526,500. That's a small increase, but impressive given the scale of the investment. It shows the company was able to maintain a positive cash position while aggressively growing. Now let's briefly touch on an important topic: the difference between financial and accounting cash flows. The financial cash flow is a perspective of investors and creditors. It is about money going in to or from them. An accounting cash flow, on the other hand, focuses on how the company's internal cash moves based on the balance sheet. The accounting approach gives us a better clarity by category, letting us isolate operators, investing, and financing. It's a clear way to analyze the health of the business. So, this brings the question of, was the company's expansion a smart move? First, they transitioned from a sole proprietorship to a corporation, which opened the door to capital markets. This allowed them to raise funds by using stocks and debts, rather than relying just on their profits alone. They spent heavily on fixed assets, signaling confidence in long-term growth. Plus, their new corporate structure increased credibility with banks and investors, making financing way more accessible. All of this points to a strategic expansion aimed at scaling up in the future. To wrap this up, East Coast Yachts is generating a strong operational cash flow. It's investing heavily on its growth, showing it's committed to being very successful in the future. And even after those large investments, it is still with a positive net cash flow. My recommendation is to support the expansion. The numbers show it was a calculated and well-managed move that sets the company up for success in the future.